have $100,000 of income and you are reporting $50,000 of charitable deductions or $70,000 of charitable deduction, that's not normal. To have the charitable deduction be such a large part of your income when it's 50,000 or 100,000 is, in other words, if somebody has a $10 million of income and they have $5 million of charitable deduction, that's high, but you could still live with the other 5 million, less
Correct.
taxes. So that by itself is not as suspicious as someone that has $100,000 and they're trying to take a $50,000 tax deduction for charitable contributions and then living on 50,000 minus their taxes. That is a lot less normal. So
Sure.
the computer picks up on things like this in proportions, and that could trigger an audit as well. Certainly when there's different levels of audits. There's a preliminary review, and then there's more in-depth review, and eventually a field audit. And in forensic audit, more in cases where they believe that there's criminal activity from the get-go. But having your taxes done by an accountant certainly lowers your risk. When you do it yourself, there's a little bit more room for error. The IRS knows that because they're not just looking for fraud by a criminal mastermind. They're also looking for mistakes where by making an adjustment, they could collect more money. So folks that mistakenly even take a deduction that they're not entitled to, they look at that. They look at that and they try to recover that money, just a return and recover that money.